What happens to your business if you die? I find that many business owners are so focused on what happens on a day-to-day, and they're probably good at profits, and they're looking at operations and the sales and the revenues and etc., 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 but they have not done any long-term plan. So my question to you is, if you die tomorrow, the real question, and we're looking at this from a financial standpoint, is who actually gets the business? Do you know that? The other question is, what does the CRA take first? Right? Do your family get a chance to have the funds and strategize and how the funds are used? Another question to have is, does your family get what you think they're going to get? Because you have all this assets, and you probably say, okay, this is what I want my family to get. So the question is, will that happen? And where we start is, we start by saying what actually happens and how it's treated by CRA in terms of your business. At that, the CRA treats your shares as sold at fair market value. This concept is called a deemed disposition, right? Whether or not anything is actually sold, it's treated as if it's sold, right? And then the bill lands on your estate, right? So the tax is due from your estate. And often what happens is you will have to deal with that before your family sees any penny from your business if you have not taken the steps and made the plans. You could have, 7 figures in terms of retained earnings inside your corporation, and you've thought you've done quite well, and if you pass away, your family will be taken care of. But if you have not structured things properly, what could potentially happen is that your estate has hundreds and hundreds of thousands of dollars in potential tax bill if you have not taken a step and made sure that what you want to have happen. Now, what I've also seen is that many business owners work very closely with their accountants, and they think this is all taken care of. Quite frankly, many accountants just file taxes. You have some others who help with tax planning. But many, very few consider estate planning. And quite frankly, that's not a criticism of accountants, because they're often just paid to just do that, file taxes and tax planning. And so the estate planning portion of it is not something they typically get involved with, and maybe they don't have the expertise or the qualifications to do that. So what I've seen is that there is this reliance on accountants to deliver just that, but people have missed the guide. So let's look at 3 owners and 3 potential outcomes. One is a sole owner with no plan. So you're just doing your thing day to day. You haven't considered what will happen at all. The CRA typically comes in and take the largest cut. All right. They take the taxes, and then the family's left with a business. And this is a business, quite frankly, that in many instances they have no idea how to run, no understanding of the systems. And, what revenue comes in, you want to maintain it, but you're probably trying to sell it as quickly as possible, because the longer you hold it, is the more it loses its profits, because this is not a business that you're properly set up to handle, and so the family sells at a discount. So that's one circumstance. Let's look at the circumstances where you have, say, there are more than one shareholders. The surviving spouse, by the way, the surviving partner now, by the way, is now in business with the deceased spouse. Let's call it the surviving spouse. And often what I've seen is nobody really wants that. Not because the surviving partner doesn't get along well with the surviving spouse. It's just that surviving spouse probably has no context of how the business, does not know how to run the business, does not know how to make decisions relating to the business. And then what happens is sometimes the conflict follows. So what should have happened there was that there should have been a shareholder agreement that is put in place to state what will happen. And quite frankly, what we'd have is a buy-sell arrangement, whereas it is structured in such a way that if one partner passes away, the funds are there in the corporation in order to pay the surviving spouse. And so the surviving partner takes the rest of the corporation and now holds the entire thing 100%. We're assuming here there are two shareholders, and then the surviving spouse walks off with the fair market value of that share, and both parties are happy, and it's done well. One way to do that is to do that through insurance. because when if there's an insurance policy there, buy-sell arrangement, then the life insurance is paid out. It goes into what's called a notional account. It's called a CD, a capital dividend account. It's not a real account, but it's an account for accounting purposes that allows for tax-free dividends to be paid, and the business transfers cleanly over to the shareholder, and the funds that comes in tax-free gets paid out to the family member for the full value of that share, right? So this is a tool, insurance, that fixes a lot of that. Corporate owned life insurance. Another thing to consider is, beyond just the buy sell, is also key person insurance. And what you may have is not necessarily a shareholder, but you might have somebody who's critical to the business. And if you do not have that person in the business, it's going to have huge implications. And quite frankly, it might even put that business in a situation where it loses significant profit, or maybe even start to be in a place where it starts to be at a loss. And so what you want to do is have insurance in place to protect that individual, to protect the business from any financial loss or losing that person, right? And so you get these funds in. It gives you time to protect the revenue. In addition to that, what you're able to do is buy some time to get somebody who could replace that individual. And so that is also another reason why you may want to have insurance. And again, the huge benefit is the amount that's paid out in many instances is tax free, right? So I've kind of wrap things up. You spent decades building something valuable. The plan for it deserves the same type of attention. I see people put, their work, especially business owners, you're working 7 days a week, 6 days a week, even if you're doing 5, whatever the case is, you've put a lot of time, energy into this thing. And because you haven't planned it properly, unfortunately, the benefits that should be coming to you and your family, that does not happen. So if you see the situation, you want to take steps. And if you want to take steps to see how that gets solved, feel free to reach out. Again, hopefully this was helpful. And if it was, like, share, subscribe, and check out the next video. Take care.